Hi there, and welcome to our video on the pessimism bias in trading. The pessimism bias is a behavioral bias that affects our judgment on probabilities, and it shapes an inefficient behavior for traders, especially while taking profits. But let's go step by step. As a first step, we will take a closer look at the pessimism bias and show you an experiment which clearly shows its effect. Second, we will derive what this means for traders and their behavior. And third, we will discuss countermeasures you as a trader can take to limit the negative influence of the pessimism bias on your trading. I'm Jonas, co-founder and CEO of Hoc-trade. Let's get started. If you are interested in trading psychology, the different biases underlying our oftentimes destructive trading behavior, and finding ways to improve your trading, feel invited to have a look at our Trading Academy playlist. We have already made videos about other trading biases such as the gambler's fallacy or the blind spot bias, and there are many more to come. Behavioral biases have a strong effect on our trading, irrespective whether you're trading Forex, crypto, stocks, commodities, futures, or whatever other market. They are oftentimes overlooked, as many traders heavily focus on the more technical parts of trading. However, given that 85% and more of the traders actually lose money in trading, with all the technical assistance at hand, while flipping a coin should give you a 50-50 chance of winning, we can derive our behavior indeed has a strong influence on our performance. Those actions triggered by behavioral biases are unfortunately mostly with a negative effect on our performance. Not everyone holds the same behavioral biases. However, as traders, we can well understand the impact of certain biases on our trading performance and analyze whether those biases apply to us as well. The pessimism bias is one of those, and while biases can have effects on all different parts of trading, this one is mostly related to our profit-taking behavior. Many traders are afraid to touch the area of trading psychology, including all the behavioral biases underlying it, because it's complex, can be subjective at times, and asks us to look inside ourselves. It is not as straightforward as looking at some readily available trading indicators. However, we will do our best to outline the pessimism bias for you in a structured way, clearly explain how it affects our trading behavior, and provide tangible options on how to work on it if you yourself are victim to the pessimism bias. So, what is the pessimism bias? The pessimism bias describes the tendency of people to overestimate the likelihood of negative events happening and at the same time underestimate the likelihood of positive events happening. As the name already suggests, people tend to be more pessimistic about a positive outcome. What does this mean? To really understand this, let's have a look at an example based on an experiment that was actually performed like this. Imagine you will get 10 coin flips, and every time the coin lands on heads, you are given 10 US dollars. Now, how often do you expect to win? Well, I think it should be pretty clear that based on probability, the answer most of you have in your head is 5. However, the 1,500 experiment participants answered with an average of only 3.9. As you can see, the participants overestimated the probability of negative events, showing a strong behavior of the pessimism bias. There are very strong interlinkages of this to trading behavior, which can be witnessed with many traders. However, before getting into this, let's understand a bit more about the pessimism bias, as this will make those connections to typical trading behaviors even more obvious later on. The pessimism bias exists both on a personal and a societal level. However, we are going to focus on the personal level, as this is the layer which really influences your trading. Additionally, the pessimism bias is both general and situational. What does this mean? The pessimism bias may have an accelerated influence on your behavior depending on the situation or the emotional state in which you're in. I believe it's quite easy to imagine that you may be more pessimistic in case you are in a bad mood anyways already. That may sound a little obvious, but becomes extremely important to remember when we are discussing the impact on the trading behavior. So, how can we witness this pessimism bias in trading now? There are actually multiple ways how the bias can affect our trading. Let's talk about the probably most destructive one here though. The impact on how you manage your profit trades. Every trader learns in the beginning that the key to success is to cut your losses early and let your profit trades run. On the profit side, Warren Buffett also framed it nicely when he said, "When it's raining gold, reach for a bucket, not a thimble." All that means is that you as a trader should strive to win big when you're winning in a trade. Evidently, many traders struggle to let their profitable trades run, and the pessimism bias plays an important role here. Once the trade is in profit, many traders decide to manually close their trade without waiting until the trade reaches its designated take profit level. Why? Well, there can of course be multiple reasons, but one of them is that traders prone to the pessimism bias overestimate the probability of negative outcomes. So the trade reversing and going into loss from its current profit. Therefore, they decide to manually close the trade with a smaller profit. Thinking back to the experiments we just discussed, if we would only expect a payoff of 3.9 heads in 10 coin flips, it is understandable why we would close our trade early in profit, as the trade may have already reached our discounted probability. However, this bias-based behavior is extremely destructive to our trading performance. We keep our profits small, but let our losses become big, pretty much setting ourselves up for an overall trading loss. How does this play out for a trader? The Hoc-trade AI found significances in the trader's data and automatically simulates for the trader what would have been the profit in case the trader would have not chosen to manually close that profit trade, but rather let it run until it reaches the take profit or stop loss. Thereby, the trader can directly see whether closing the trades manually was actually hurting the performance or not, with many times showing a worse performance in case the trades were manually closed. Moreover, and remember when we talked about the situational nature of the pessimism bias earlier, the effect is oftentimes even accelerated for traders. In case the trader is already feeling down or in any other negative emotional state, the trader might even be more likely to be victim of the pessimism bias. How does this apply to trading? You may be in a bad mood already when trading, maybe a bit depressed or any other feeling. You may have just had a lost trade and thereby your mood drops. And this is actually something we can measure. Therefore, the Hoc-trade AI also tracks the probability of manually closing a profit trade in case the trader had a lost trade beforehand versus your average likelihood of doing so. As you can see, there can be strong interlinkages between the pessimism bias and your trading behavior, which is unfortunately mostly having a negative effect because it strongly contradicts the basics of profitable trading. What can you do though if you are receptive to the pessimism bias? Working on their own trading psychology and the resulting actions is unfortunately not as straightforward as changing the settings in your indicators. However, if done correctly and consistently, it can have a much more beneficial effect on your trading performance. In case of the pessimism bias, let me highlight 3 aspects on how to deal with it as a trader. First, situational awareness. If you have watched videos on other trading biases from us, you probably know already that this is the very first step in handling the impact of a trading bias on our performance. Trading biases are, by its nature, unconscious and therefore go for a long time completely undetected. You need to know the bias exists. understand it in its basics, and the next time you're cutting a profit trade early, you will probably think about the pessimism bias and can review your thought processes at this moment. This is the first big step. Know about it. Detect it in your own emotions, thoughts, and actions, and gather a better understanding of yourself. Second, reduce or secure instead of close. As with any other trading bias, a sudden, complete shift in behavior is usually not helpful and sustainable, as trading is a complex system of technicals and psychology. A sudden change in one area will most likely also impact other parts of this complex system. Therefore, gradual adjustments are usually more beneficial. Think of it as a process instead of a one-time shift. In terms of the pessimism bias, we as a trader have multiple options at hand. Closing a trade in full as soon as it is in profit is a very strong action. However, why not reduce the position size? We satisfy our mind to a similar extent by taking some profits while letting another part of the trade run. Thereby, we also see how the trade would have turned out if we didn't close the trade early, as part of our position is still running. A second attractive option is to secure your trade. What do I mean with this? A loss after we were in profit already hurts many traders more than a loss that directly went into loss. This is actually part of the Nobel Prize winning prospect theory. But this is such an important theory that it deserves a dedicated video which is coming soon. Now, if we rule out the possibility that our trade could still go into loss, it calms many traders and enables them to ride the winning trades without cutting their trades too early. To do so, we would set our stop loss to the break-even level of the trade instead of closing our winning trade early, and enjoy the ride of the trade knowing we are secured from any losses in this trade. If you would like to derive the profit level at which it makes most sense for you to set your stop loss to break even, you can also have a look at the Hoc-trade analysis Profit Secure Payoff from Reverting Trades. This analysis tells you what would be the difference to your current profit in case you would have set your stop loss to break even at the certain profit levels in every trade that reaches those profit levels. As a result, you as a trader know at how many pips profit, in case of a Forex trader, would I be best off to secure my trade. In this example, the trader could have increased the performance by 0.15% per trade, or $2,691 US. Overall, in case a stop loss at break even would have been set every time the trade reached 16 pips profit. Third, leverage technology to assist you. There are plenty of trading journals and analytics tools available for traders, which support you in tracking and analyzing your trading data and derive the effect of trading biases on your performance. Visualizing and periodically revisiting the effect of those biases very much helps keeping them top of your mind and deriving strategies on how to improve. The Hoc-trade AI and the charts I've shown you before serve a similar purpose by looking at very specific dimensions of your performance and behavior. It is important to broaden your view also when analyzing data, such as in the example of cutting your lost trades early. Only looking at this chart gives you some insights. However, including the dimension of having a lost trade beforehand, so pretty much a trigger point for your situational pessimism bias, adds a complete new dimension to the analysis and can produce a much more holistic view. If you would like to test the Hoc-trade AI or are interested in discussing further, please feel welcome to join our Discord server. We are currently testing Hoc-trade in a closed setting on the Discord server before making it available to the public. I put you the link down in the video description. I hope you enjoyed this quick snapshot into the pessimism bias, how it can affect traders' behavior, and what you as a trader can do to soften its impact. If you did, please feel invited to leave a like and subscribe to our channel. There will be plenty more trading psychology related content. As already said initially, specific trading biases do not apply to everyone, as our individual characteristics and experiences differ. Moreover, behavioral biases oftentimes interplay with each other. The same applies to the pessimism bias too. Actually, there also is an optimism bias, which can even coexist in the same person, and the dominance of the two depend on the situation. We will cover the optimism bias in another video. The pessimism bias itself may strongly impact your profit-taking behavior, which is oftentimes overlooked in trading because much focus is placed on finding the right entry and reducing our losses. However, losses are only half of the equation, and in order to still be profitable while accepting our losses, we need to make sure our profits are big enough to outweigh our losses. So, don't let the glass be half empty, but half full. Don't discount your winning probabilities and win big. Thank you very much for watching. Happy trading and stay safe. Please be aware that we at Hoc-trade are no financial advisor. This video is for entertainment purpose only.